happy to see many of you, and I hope that you realize that in the next 30 minutes, you will learn something new. Because this talk by Christoph from Point 9 Capital, he has experience over the past 10 years, both as an investor but also as an entrepreneur when it comes to software as a service companies. Some of the experiences and some of the panels that we've had during the past days were a bit more up here. Those next 30 minutes is not going to be like that. He will give you 9 specific learnings that you can go and apply very next week on your own company. Okay, Christoph, Point 9, please come join us on stage. Slido.com. If you have not tried it yet, please do so, because you can do questions for Chris afterwards.
Good day. Thank you, Xenia. I hope you didn't oversell my presentation too much. You can let me know afterwards. Hello, everybody. I'm Christoph Janz from Point 9 Capital. We're an early-stage venture capital firm based in Berlin, primarily focused on SaaS and online marketplaces. We invest all over Europe, as you can see here from some of these logos. We've invested in countries like France and the UK, and obviously Germany as well, Spain, and many other countries. So we're pretty focused on 2 sectors, being SaaS and online marketplaces, pretty agnostic when it comes to location. But that said, it is in fact great to be in Copenhagen. Copenhagen has a very special place in my heart, and that is mainly because of these dudes here, which I met almost exactly 10 years ago, the founders of Zendesk. And if you look at it on a map, this is where really the Zendesk story began, in Alexander's apartment, and this is where we are today. So just a couple of minutes of walking distance away are we today from where some SaaS history has been written. Think about that. So this is how the world looked like 2008. This is how iPhones looked like. This is what American presidents looked like. Good times. And this is what I knew about SaaS, aka nothing. I have since then focused on SaaS and have learned a couple of things, and I want to share some of these learnings with you in the next 25 minutes or so. And because we're here in Copenhagen, I'll try to connect some of these learnings back to the Zendesk story. All right. So the first topic I want to talk about is fundraising, since that is a topic which most founders will face sooner or later, and usually sooner rather than later. And let's take a look at the following chart here. You have a time axis over there, and then on the y-axis you can see the level of interest that you're getting. And when you start out, what usually happens is this. Well, basically nothing happens, because nobody cares, nobody is really interested, and you're really struggling to get any excitement or any interest among investors. And then you get a term sheet, and the next day every fucking investor in the world wants to invest. And it was a bit like Zendesk. At Zendesk it was a bit like this too. So raising the seed round was relatively difficult. Raising the Series A, which eventually CRV from Boston did, was hard too. And then the Series B was done by Benchmark, and then basically everybody wanted to invest. And so the question for founders is like, why is that, and why does it matter, or what can you do about it? Obviously, the short version of the answer is that there is a lot of lemming behavior among investors, not excluding ourselves from that. And that is because investors just look at so many different companies. They have to make decisions very quickly and in the absence of a lot of information, so they try to take clues from other investors. The question is, what can you do? Like, what can you do to get the first term sheet, which will then, like a domino effect, lead to other term sheets? So the obvious idea would be you just fake it until you make it. You basically make up a term sheet. You might want to try it, but it's pretty risky. It can backfire pretty quickly. So what I would rather recommend, and this is the learning for this topic, is that you really get your act together. You make sure you have a really great story. You create a great deck. You make sure you're on top of your KPIs, and importantly, you should also run a process. You should have 10 or 15 investors who you think would be a good fit for your company and for that stage, and then you provide them with information simultaneously so that all of them are on the same page, so that you can control the process and the timing, so that if you actually get that sudden spike in interest, you can actually leverage that, and you don't have various people on various different timelines. The next topic is about power law, which is kind of a VC topic, but it's also related to fundraising, and I think it's also useful for founders to understand this at a high level. If we look at this chart, it represents a typical venture capital portfolio. It shows the company rank on the x-axis and the return on the y-axis. And what this is about, and the power law is basically the idea that a small number of portfolio companies, some big winners, represent the vast majority of the returns. And so you can see that you might think it looks like this. So the first company in a portfolio of about 30 companies produces a massive return, and then it goes down and goes down. And so the company number 15 or number 30 contributes much less to the overall return. But the reality is actually that it doesn't look like this. It looks much more like this. So it's a lot more extreme. This has been shown time and again by all the best funds in the US and the funds which invest in these funds. Almost all venture capital portfolios that produce a good return, which is usually considered like 3x or 4x or so on the total fund, can only do this because they have 1, 2, 3 companies that create an outside return. And if you, as a founder, want to raise from a VC, you have to be convinced of and be able to convince others that you are going to be on the far left of this, like one of the top 2, top 3 companies. If you're not sure that you can be one of these outliers, and if you maybe not even have the ambition to build a large company with $100 million in ARR, then you should probably not raise venture capital, because then there's just not a great alignment between the shareholders. And coming back to Zendesk, obviously, if we hadn't had that idea that Zendesk could become really, really big, which eventually then was supported by some data, then we wouldn't have been able to raise money from CRV and Benchmark and Matrix and several other VCs over the course of the company. Let's talk about product market fit. I'm using another chart here with a time axis on the right and the degree of product market fit that you have on the vertical axis. And I think many people, when they start out, think that this might look a bit like this. So you develop the product, you remove features. Yeah, you shouldn't. Sometimes you should do that. But I was going to say you remove bugs and you add new features, and but you're not really getting so much great signals from the market. But then you launch a new version, and boom, you suddenly have great product market fit. You're in the mythical land of product market fit, so to speak, and you live happily thereafter. And I have heard these stories a few times. So it can happen, like if a company pivots from something to something completely else, and suddenly people love that. So that might happen, but it's not the usual case. What I think is much more frequent is a development like this. So what I'm trying to say here is that it's quite often that you launch your product, you get some customers, some revenues, you think you have product market fit, then you lose some customers, you have churn, competition comes up, your website is down, like all kinds of things happen which make you wonder how strong your product market fit actually is. And it might take you until 1 million in ARR, or maybe even longer, until you really know you've nailed product market fit, you have a product that a certain type of customers actually wants, and you know how to distribute it to that customer base. And so the learning here is that the road to product market fit can be long and bumpy, and you might need to raise more money to get there than you think. And importantly, you shouldn't try to scale before you have product market fit. This will almost inevitably lead to a disaster. Next one, let's talk about pricing, which is a favorite topic of mine because pricing really has such an incredible leverage on any business. So this is how many SaaS companies that we see price. They have a plan for SMBs, and then another plan for bigger customers, enterprises, where the price is roughly double the price of the SMBs. And what I think how most SaaS companies should actually price is more like this. So the message is you should charge enterprise customers much more than SMBs, and in most cases more than you think. So by default, our experience is that most founders ask for too little money when they talk to bigger customers, and I think there are several like more or less obvious reasons for that. Most founders haven't worked in large corporations, so they don't have the first-hand experience just how expensive everything is at large companies. You can usually just add a zero to all cost items, just the way large companies operate. And obviously, as a founder, you also know all the bugs of your product, and you know all the deficiencies. So maybe you don't dare to ask for a lot of money. And then finally, many founders would also prefer not having to talk to customers. They just want a self-service business, and like asking for a higher price obviously might create some friction in the sales process. But if you're dealing with enterprise customers, and that is learning number 4, you should really consider asking for a lot more money. You usually don't have that much to lose because people rarely run away, and you have a lot to gain, because if you manage to double your pricing or maybe even triple your pricing, that can be transformational to your business, and we'll come back to that a little bit later. Number 5 is scaling paid acquisition. So again, a chart here. What we often see in business plans or budgets is something like this. So the assumption here being that you have a certain marketing spend and you increase that over time, but your CACs, meaning your customer acquisition costs, they stay mostly flat. So basically the assumption is that you can scale marketing spend and then you get a linear proportional number of customers in return for that spend. That is very rare in B2B SaaS. It's much more likely that it's going to look like this. And the reason behind that is that in contrast maybe to consumer applications, let's say e-commerce, where you have a large audience and you can do mass market advertising like TV, where you can deploy millions of dollars in a channel or tens of millions. This usually doesn't exist. So in B2B SaaS, it's much more normal that you first capture the lowest hanging fruits, like the warmest customers or the warmest prospects, and then those cheap channels exhaust, and you have to find new ways to acquire customers, and they are typically more expensive. So the learning here is you shouldn't assume that PPC or any other way of paid marketing will easily scale. You have to be more creative than that. An awesome product is obviously important, content is important, NPS matters, and it hasn't been different in case of Zendesk. Like one of the reasons that Zendesk was successful was that customers really loved the product. It had a super high NPS, lots of word of mouth. It was not mainly because of the success of paid marketing. Topic number 6 I want to talk about is the hiring of a VP of sales. And for that topic, I'm going to borrow a slide from Jason Lemkin, who probably everybody in the SaaS world knows. He wrote a fantastic blog post about the 48 types of VP of sales. And the gist of that is the fact that the requirements needed and the skills needed and the objectives of VPs of sales that you need throughout the journey, they change dramatically at least a couple of times. So in the very beginning, you need an evangelist, somebody who really figures out what the customer wants and how you can get to product market fit and what the sales playbook looks like, because none of this exists in the beginning. And this person is most likely going to be you. If you, as a founder, whether you're good at sales or not, whether you like it or not, it almost certainly has to be you, because any of the VPs of sales who are great for later stages, who Jason calls like the Mr. Make It Repeatable or the Mrs. Go Big, they don't want to join a small startup. If they wanted to join an early stage startup, it would almost certainly mean that they are not good at what they're doing, unless you find some kind of unicorn who used to be VP of sales and now suddenly becomes an entrepreneur. But that's just very unlikely. VPs of sales, they want to make money. They are good at managing people, but in the early stage, there's neither money to make for a salesperson nor a lot of people to manage. So the first VP of sales is most likely going to be someone from your founding team. You have to convince the first couple of customers yourselves. Then maybe when you're at around $1 million in ARR or so, you should try to find a VP of sales who can scale you to, let's say, 10 or 20 million of ARR. You shouldn't optimize that hire for somebody who you think can take you all the way up to 100 million ARR. It's just too unlikely that one person can scale for such a long period of time. So make sure you always hire for the right stage, usually meaning for the requirements of the next 24 months or so. All right, let's talk about getting to 100 million in ARR, which is a topic which is very important for VCs, because VCs want to invest in companies that have the potential to get that big. It may not matter to you as a founder, because it may not be your goal, and that's perfectly fine. But if you want to raise venture capital, like at least a couple of millions or so, then it probably should be your goal. Otherwise, there is not a great alignment between you and your investors. So let's look at some of the ways how you can get to 100 million in ARR. And this is a chart which you might have seen before, which shows in a very, very simplified way, basically mathematically, how many customers you need for a given ARPA, meaning average price per account, or average revenue per account, per dollar per year. For each of these ARPAs, how many customers do you need to get to 100 million in ARR? And as you can see, it's a logarithmic scale, so each next step represents a 10x difference here. And obviously, this is a simplification. There are many, many more ways how you can multiply two numbers to get to 100 million. That's very trivial, but we think this kind of simplification is useful for founders as they think about the type of customers that they want to acquire, and then as part of that also what kind of sales and marketing process they need and what kind of cost structure they can afford for that. Like if you need 100,000 customers, you probably need a viral product, because it will probably be too expensive or impossible to reach them in a different way. On the other hand, if you're in this elephant area and you need only 1,000 customers to be a hugely successful company, then maybe you can build an outbound sales force or a field sales team and basically just visit them all. So the learning here is know what kind of animals you're hunting and align your customer acquisition costs and your COGS with your pricing. And quickly to mention again, Zendesk here. Zendesk was eventually able to sell to a pretty broad variety of customers, from like the rabbits over to deers, all the way up to elephants and even bigger customers, but they didn't do it at day one. Like, they started with SMBs and then they went up market slowly but surely. Number 8 is about the startup graveyard, and we're again visited here by these cute little animals here, and on the right axis of this chart you see the CACs, meaning the customer acquisition costs, and on the y-axis you see the lifetime value. And each of these animals or positions on this map represents one type of company that has managed to bring customer acquisition costs and lifetime value in the right balance to build a large and scalable, profitable company. Now, if you look at the chart at the position in the top left, this is so rare that I'm using a unicorn with 3 heads to visualize that kind of animal. So these are companies that combine low CACs with high LTV. I think Slack and Dropbox are probably the best, maybe almost the only examples of that category. Companies that manage to combine a viral customer acquisition engine with a very high degree of monetization. And I think Zendesk has some elements of that too. Like from the early days, there was a little bit of virality because companies could build their help forums online, and it had like powered by help desk signature, and some of the emails were powered by Zendesk. So there was a little bit of that going too. So Zendesk was probably somewhere on this left part as well. Oh, what happens if you're there? Like if you're stuck in that bottom right corner, it basically means your CACs are too high relative to your lifetime value. So then you're basically a zombie. And if you want to like survive as a company or even grow, you have to find a way to either go up, meaning you increase your lifetime value by decreasing churn, increasing pricing, going up market, adding products, features, anything of that, or you decrease your customer acquisition costs by finding a viral hook or better distribution channels, or do a combination of all of these things. Okay, and the last one is the almost famous or infamous team versus market question, which is kind of like an old debate among investors. Like, what is more important? Like, is a team, is it better to invest in a great team in a not so great market, or vice versa? And my view at this looks a bit like this. So there are companies with good teams, there are companies with good markets. A small part of these companies with good teams have excellent teams. Small number of companies with good markets have excellent markets, and then there is some overlap between those with excellent teams and excellent markets, a pretty small overlapping area. And then you add some luck and timing and all kinds of other things, and then a unicorn is born. And this is, I mean, there's no, it's probably not surprising that this is rare, otherwise we wouldn't be calling it a unicorn. But I think like to have this level of success like Zendesk or a handful of other companies, the stars really have to be aligned. It's not either a great team or a great market. You have to have an excellent team, an excellent market, all kinds of other factors. I was actually talking about this the other day with Morten and Alexander, and we were like thinking about like why was it actually that Zendesk was so successful and thousands of other companies were not, and we came up with dozens of reasons. So there's no simple answer to that. That's all I have. If we had more time, would have some bonus slides, but I think we might have some audience questions, and I have uploaded the slides to saaslearnings.com if you want to have a look, and you can also email me at christoph@point9cap.com.
Exactly. Thank you so much.
Pleasure.
So Slido.com, hashtag TechBBQ. If you have any questions, we already have someone coming up here. So how do you justify the extreme difference in pricing you suggest towards your enterprise clients?
Yeah. I mean, the simple answer is that you're delivering a lot more value to bigger customers than to smaller customers. Then if you go a level deeper, it might be, and it typically is, that you just have a much, much bigger business problem to solve. You have a lot more users. You have probably enterprise features which SMBs don't need around permissions, reportings, analytics, SLAs. So enterprises, they just have bigger problems to solve, bigger requirements, and bigger budgets.
It's right. And to be very technical, there's a very specific question from S. Do you prefer CAC including salary spend or only marketing costs?
I think it depends on what you're trying to solve for. Like, what's the question that you're trying to answer? If your question is how much can I spend on a customer relative to the lifetime value of that customer, then you should, of course, look at all costs associated with customer acquisitions, which include like sales, benefits of everybody in sales and marketing, and the program spend and everything. But there might also be a scenario where you only want to look at like the marketing spend if you want to compare different channels.
Cool. Can you tell a bit about marketplaces, but with a subscription model, please?
I don't think so. Marketplaces with a subscription model. I mean, we have seen a couple of like so-called SaaS-enabled marketplaces where the supply side on the marketplace, for example, a doctor on a platform such as docplanner.com, gets a SaaS product to manage their practice or their calendar, and at the same time it's a marketplace where patients can book. So it's a combination of marketplace and SaaS. But I'm not exactly sure if whoever asked that question was referring to that.
It was anonymous, so I would know.
We'll never find out.
Tourist. What have we here? Yes. So, as an investor, you cover both SaaS and marketplaces. But from an investment point of view, do you look more towards horizontal SaaS solutions, or is vertical solutions equally interesting to you?
I think both horizontal and vertical SaaS companies are very interesting. There are large companies that have been built obviously in horizontal categories like accounting, CRM, marketing, HR, but there are also very successful ones in verticals, like Viva in the pharmaceutical space, for example. We're also an investors in a couple of vertical ones. They're just a little bit different. Usually the vertical markets are smaller, which depending on the vertical might limit the size of the opportunity, but at the same time you might be able to get higher market share because there's less competition, and it might be easier to find product market fit in a market like this, and it's easier or more straightforward how you sell and market the product, because from the get-go you know much more about what your customer looks like. So I think in general, we're very interested in both vertical and horizontal SaaS, but it then obviously always depends on all kinds of details.
Cool. So just one last question. We're starting to see something about investments, and I'm trying to summarize them up into one question because we're almost out of time. So I know some of the startups sitting here amongst the audience, and some of them look to Point 9 Capital and say, we would love to have you as an investor. And that is to a great deal due to you as a person. But do you even have time for your portfolio companies, you as a person?
Yeah, of course. I mean, it's a challenge. It's kind of our time is the bandwidth is the limiting factor for what we're doing, and therefore, like for example, in 2007, we didn't make that many new investments because we were really busy with the existing portfolio. So taking care of the existing portfolio comes first. But it's not just me. We're a team of 6 people in our investment team. We have a couple of venture partners, board partners supporting us, and I think we've found a model to still invest in new companies, and also some companies we work with very closely for 10 years. But in other cases, maybe it's a shorter period of time, because like Zendesk is the best example maybe. Like, I mean, I've been pretty involved for a couple of months, but then things went on so quickly. Like, they raised tens of millions of dollars from great investors. They moved to the Bay Area, and if you have like Benchmark and Matrix and CRV on board, then at some point I can basically ask myself, what am I doing here? Am I still needed here? Probably not. So if a company goes on to raise a great Series A or B from great follow-on investors, then we're also happy to pull back a little bit, and we'll still close to these companies, and there's still all kinds of things that we do together with the portfolio, but then at least we're not the only ones looking after the companies.
That's very cool. Thank you very much.
Thank you.
Cheers.